Hello, dear colleagues. We are ready to start the next session, session number 2. My name is Olesia Verchenko. I am Academic Director of Kyiv School of Economics, and I will be chairing this session. In this session, we have 2 very interesting papers on central bank communications, of course, and expectations, very much in line with what we have heard earlier today. We have 2 interesting papers, and I would like to invite the authors of those papers. Those are Marek Jarocinski from European Central Bank, and his discussant is Wouter den Haan from London School of Economics. And the second paper, the author is Zeno from University of Heidelberg, and the discussant is Rüdiger Bachmann from the University of Notre. I would like to invite all speakers and discussants to the scene for this session, please. Okay, we are almost ready to start. You know the rules, I guess. The rules are you will have 25 minutes for presentation, then there will be 15-minute discussion, and then 5 minutes of questions per paper. Okay, we are ready to start.
Okay, thank you very much. Thanks to the organizers for putting our paper on the program. This is joint work with Peter Karadi. We are both at the ECB, but of course the views and opinions that I will express are our own and not those of the ECB, or not necessarily those of the ECB. So in this paper we study how financial markets react to central bank policy announcements. And in particular from this central bank, from these financial market reactions, we isolate the news about monetary policy and news about the economy, or at least our central bank's views about the economy. And then we track how the economy responds to each type of news using a vector autoregression. So first, so you can take for granted that monetary policy announcements by central banks that they contain news about monetary policy. But the finding of the paper is that they contain also a lot of news about the economy. So by a simple measure, the news about the economy account for something like 1/3 of the variance in the US, and even closer to half in the euro area. Moreover, the economy responds very differently depending on what type of news was contained in the announcement. So a surprise increase in the interest rate can be contractionary. By that I mean that output and prices decline. When the surprise increase in interest rate reflects news about monetary policy, or as we say, if it reflects a monetary policy shock. However, perhaps more surprisingly, a surprise increase in the interest rates, in the policy rates, can be expansionary, meaning that output and prices increase thereafter. And that happens when the policy announcement reflects news about the economy. And this is what we call a central bank information shock. So I want to highlight 2 implications of these findings. So first, private agents learn something about the economy, not just about policy, from policy announcements. And the second is that these news about the economy, they attenuate our estimates of the effects of monetary policy, right? Because we mix those expansionary and contractionary effects. So monetary policy is more powerful than we might think. So the plan is the following. I will first show you the key data that we're using. Then I will discuss the selected literature, and then I will show you the VER, the vector autoregression that we are estimating, the identification, impulse response functions, and then I'll discuss the structural DSG interpretation. So the data that we are studying here are surprises. So if P is the price of a financial asset and tau is the time of a central bank announcement, then the surprise is the change in the price between 10 minutes before and 20 minutes after the announcement. right? So we look at we compute those surprises for interest rate derivatives and for stock prices. So 10 minutes before the announcement, those financial instruments, they price in everything that the market expects about the policy. So if financial markets respond at all, yeah, must be because there was something surprising in the policy announcement. So that's why we call this a surprise. And so we compute them for interest rate derivatives for the Fed fund futures in the US and for the Ionia swaps in the euro area. So we look at these derivatives that contain markets' expected path of the policy rates. So in this case, we capture at least some near-term forward guidance, not just current policy. And then we also look at the stock price responses to policy announcements. In the US, we look at this S&P 500, and in the euro area, the Euro Stoxx 50. So to make it concrete, let's think of an example. So let's take the FOMC announcement on March 20, 2001 at 2:15 p.m. So the following piece of news is released to the public. The Federal Open Market Committee, at its meeting today, decided to lower its target for the federal funds rate by 50 basis points to 5%. Then I've clipped there a big part of this announcement because it would not fit the slide. But there are a few paragraphs of some economic analysis. And then this analysis suggests substantial risks that demand and production could remain soft. Okay? This gets released at 2:15, and then we can go back to our data set, and we see that the Fed fund futures and stock prices both drop between 2:05 and 2:35. Yeah? So surprises in both kinds are negative. So now Fed fund futures drop, so markets did not price in such a big cut. They were expecting, so the economic data were weak. Markets were expecting a cut in the interest rates, but they did not expect the cut to be as large as 50%. So this is a negative and expansionary monetary policy price. But now, interestingly, stock prices also fall after this announcement. Right? And so why is it surprising? So this contradicts the standard textbook asset pricing model, according to which monetary policy surprises generate a negative comovement between interest rates and stock prices. Right? So in this case, if the Fed funds rate is lower than everybody anticipated, well, first this stimulates the economy, so we expect the future dividends to be higher. We discount those higher dividends with a lower discount rate, so present discounted value of dividends should unambiguously go up. Yeah? So stock prices should go up, and yet they dropped on March 20. And the message of the following slide is that this is actually not so unusual. That quite often stock prices react in this counterintuitive way to monetary policy surprises. So here in this plot, every dot is one FOMC announcement. On the horizontal axis shows what happened to, in this case, 3 months Fed fund futures, and within a half hour of the announcement. On the vertical axis, you see what happened to the stock prices within the same half-hour window around the announcement. Right? So the simple theory that I've just outlined suggests that all these points should be tightly aligned along a negatively sloped line. Yeah? And yet, that's not what we see. Right? The picture is this cloud of points is very dispersed. There is any negative relation there is not apparent. It's very weak. Yeah, we see this episode from March 20, 2001, and we see a bunch of others where when the markets are surprised by a cut in interest rates, stock prices nevertheless fall. Yeah, and there are a bunch of other cases where stock prices increase. Closer? Okay. So this could be due to noise. Yeah, that's of course possible. So some other pieces of news that hit the market within those half-hour windows, but there are not. I mean, monetary policy announcement is pretty much the largest piece of news that affect asset prices in those particular half-hour windows. So the way we think about these points is that this negative relation is distorted by another shock that also gets transmitted in the same half-hour window. So we think of those points as reflecting, on the one hand, monetary policy shocks that generate this negative co-movement between stock prices and interest rates, and what we will call central bank information shocks that generate a positive co-movement, and therefore, in the cloud of points, you can see realizations anywhere now, right on the plot. So that's how we think about this. Now we think of those two kind of shocks that get transmitted in the policy announcements. And then in the rest of the paper, we track how the economy reacts to both kind of shocks. And for that, we use a structural VER. I will explain in a little more detail what we do, and then we track how the macroeconomy reacts, depending on the mix of both type of news in the policy announcement. So maybe it's now a good point to stop for a while and to relate to the existing literature. So we're following a very large literature that studies the same data as we do. So this interest rate surprises, so market reactions to policy announcements, and that uses this data to understand the effects of monetary policy, right? To isolate the unexpected component of monetary policy, and then what monetary policy does, how it affects the economy. So this literature goes back to Kuttner, 2001, and there are many other papers, of which only a few are listed here. So what's different here that we not only focus on the monetary policy shocks in this data, but also on this other news about the economy, or central bank information shocks. Now, there is a subset of this literature that studies, as we do, this central bank information effects. Yeah, and there are three approaches here. So probably the most widespread approach is to try to directly measure the difference between the central bank's views of the economy and the market views about the economy. And that's done by taking a difference between the internal Fed forecast and the market forecast at the same time. And the papers that are listed here and others use this measure of central bank information about the economy. There is other research that uses textual analysis, so uses text processing tools to extract the information about the economy in the announcements. So we don't do any of this. We outsource it to the market participants to read those announcements, to interpret them, and we read off the market movements, what participants understood from the announcements. Okay, and there are a bunch of papers that follow the same route as we do. So finally, I want to mention the theoretical papers on the information channel of monetary policy by Nakamura and Steissen and by Melosi. So in these models, there is uncertainty about the state of the economy. And agents, when they see central bank's interest rate decision, they also figure out what the central bank, so they figure out also what the central bank knows about the state of the economy, and they update their own beliefs about the state of the economy. Okay. So this is the literature we're contributing to. So let me now give you some more details what we do. So our baseline exercise is a VR with 7 variables. The first 2 are those interest rate and stock price surprises. The VR is monthly, so our variables have to be monthly. So we aggregate any surprises that happened in a month T into we just add them up, and we will create a monthly time series of surprises. So these are the first 2 variables. Then the source is the updated Gurkaniak second Swanson data set for the US, and I'll talk about the euro area later. Now, we also include 5 standard macroeconomic and financial variables denoted Y here, and these are government bond yields, S&P 500, real GDP, GDP deflator, and the excess bond premium to measure financial conditions. So our VR is quite standard, except that it contains those surprises as among the variables. The surprises are IAD. So we actually reflect it. So the 0 restrictions in the VR, they reflect the fact that the surprises are just IAD, they are just shocks. Otherwise, the VR is standard. We estimate it with Bayesian methods, and we also allow, within the Gibbs sampler, we also can handle missing data on the surprises. So we don't have to have the same sample of the macroeconomic data and of the surprises, just like in the instrumental variable estimation. And this is how we identify the VR. Now, so in this table we have the variables in rows and then shocks in columns. So first we assume that these first two variables, the two surprises, that they only reflect these two shocks: monetary policy and central bank information shocks, and they're not affected by any other shocks they do not reflect any other shocks in the economy, right? And the justification for that is that those variables are measured only in these half-hour windows around the announcements. So this justifies the zeros in the first two rows, and then we just impose our two sign restrictions, right? So we assume that the monetary policy generates a negative comovement of interest rates and stock prices, just as the simple asset pricing model wants it. And then we introduce this complementary shock where the comovement is positive. Now, importantly, we impose no restriction whatsoever on the macro variables. So anything that we find in the responses of the macro variables, it's just follows from those restrictions on the high frequency part of the model. Right? So in this procedure, we decompose the surprises into two orthogonal shocks. And this is a set identification, so we have uniform prior and rotation, so we're fine with any, right? We can rotate these two orthogonal shocks, and we're fine with any rotation as long as it preserves the signs that we propose. As a robustness check, we also do a simpler, like a low-tech exercise, which we, for lack of a better name, we call the poor man's sign restriction, which means that we just take all the points where the central bank, where interest rates and stock prices can move negatively. We took all those data points to be monetary policy shocks, and all the data points where they can move positively to be information shocks. So it's like a simple, simple classification of all announcements into just these two categories. Now, for comparison, we also consider this standard high-frequency identification, where we simply introduce only one type of a surprise in the VR, namely the interest rate surprises, and we put more or less an equality sign, as much of the literature does, between interest rate surprises and monetary policy shocks. So let's actually start with this first exercise. So here we have, in the first line you see a blip, because the first variable is IID, so it only does blips. So it's a positive blip so it's a positive interest rate surprise, right, within a half hour around the announcement. And then what follows is that we see in the months that follow higher government bond yields. We see somewhat lower stock prices. We see gradually. But very gradually falling GDP and prices, and we see some increase in the excess bond premium. So this is a pretty typical picture that you get with in this kind of VR literature. So in particular, these very gradual and protracted effects of policy. So often VR studies find a price puzzle, so they find that prices initially increase after a monetary policy shock. In this case, prices do not really increase, they fall, but they do it very gradually. So now we introduce, we go back to our baseline model, we introduce two types of surprises, and we impose those two, so we separate those two kinds of shock depending on the co-movement of the two surprises. So again, you see the responses of the surprises, which are just blips because of the restrictions of the model. So let me zoom in and just focus on the lower, on those monthly, on the standard macro variables. And now, so this is the key slide of the paper, right? This shows this result that surprised us, that this simple restriction on the co-movement between interest rates and stock prices in the first half hour after the announcement, that this simple restriction is enough to separate two completely different shocks. Yeah. So the two shocks, so both shocks are interest rate hikes. Yeah, they're normalized to be interest rate hikes. And you see that indeed government bond yields remain higher for several months after both shocks. But when going down and looking at the effects of these two shocks on other variables, all the effects are completely opposite, right? So monetary tightenings that are associated with this negative comovement between interest rates and stock prices, just like the theory tells us that they should. So they result so they're followed by lower stock prices, but they are followed by a decline in GDP and in GDP deflator, and both of those are now more vigorous and stronger than in the baseline identification, and they're followed by an increase in the excess bond premium, so by tightening of financial conditions. Whereas when an interest rate hike is accompanied by an increase in stock prices, what follows is also that stock prices remain higher also for several months afterwards. GDP goes up, prices go up, and financial conditions ease. So the excess bond premium goes down. Right? So from our point of view, the standard high-frequency identification, the first column of this plot, that it's an imperfect measure of the effects of monetary policy, right? Because it suffers from this attenuation bias. It mixes together those contractionary and expansionary shocks. So that's why we see the responses to be so slow, right? So monetary policy is more potent than the standard estimation suggests. Okay, so this was the key slide, and the rest are various extensions and footnotes. Well, so here we plot shocks over time. Black are monetary policy shocks, and blue are information shocks. And the basic message is that that these shocks occur more or less throughout our sample, so that they do not seem to be present only during the crisis or only before, etc. So they are always there, the information shocks, along with monetary policy shocks. And then then we go on. We run the same exercise for the euro area. Now it cost us a lot of work to create this European data set. Now it turns out that Altavilla and co-authors have created a larger, more comprehensive data set that is public, is on the ECB website. So if you want to if you want to follow on this research, there is this tool available there. Now, if anything, in the euro area, we see the mix of monetary policy shocks and this information shocks is even more even, right? It's closer to 50-50 because any negative relation is even less visible here. And then the stories and then the impulse responses more or less reflect this this message. So. The responses of our VER to simple interest rate surprises are very weak. They are basically insignificant, and in light of our decomposition, this is because these interest rate surprises are a mix of monetary policy shocks and information shocks. Once you decompose it, you get monetary policy shocks that are contractionary, and you get this other type of shocks that are expansionary. So now, before I run out of time, I'll just try to quickly say how we think about this how we interpret these results. So one finding is that these results are just a more role for financial frictions in the transmission of monetary policy. So that's because, so we see that there's more vigorous response of prices. Now, if prices are more flexible, then generally output, then just price stickiness does not get us so much real effects of policy, and so we need an amplification mechanism. And financial frictions are a good amplification mechanism here, so they both ensure that output responses are also strong, but they also match these bigger movements in the excess bond premium. Now, the information shocks are a bit more mysterious. So we can think of at least two very different stories behind them. One is that central banks have superior information about fundamentals. They just communicate this superior information. And then we see, in these impulse responses, we see this message materializes. Yeah? So the central bank communicates strong fundamentals. We see those strong fundamentals materializing, and that's why the economy responds positively. So in this, so what happens in this case is that these announcements predict the impulse responses, right? They're not causal. And this is very much the story of Nakamura and Tyson. So the fact that the central bank announces its knowledge about the fundamentals, it has a small causal effect but markets would have, or economic agents would have learned about these strong fundamentals anyway, right? So the only difference is that perhaps they learned a few months earlier. So the causal effect is small. It's mostly just that central banks predict the trajectory of the economy. Now, another story, a very different story about these impulse responses, is that so if we think of an economy where there's some strategic complementarities, right, where agents' decisions depend on their confidence in the economy, and then a public signal does not have to be precise, but just the fact that it's a public signal, it affects the equilibrium on which the economy coordinates, right? So in this case, the announcements would cause the trajectory of the economy. So we partition interest rate surprises into these two components: a monetary policy shock, which is a contractionary interest rate surprise, and the central bank information shock, which is an interest rate hike followed by an expansion. So, and the two main lessons is first that the effects of monetary policy on the economy are stronger once we take care of these information effects, because we get rid of this attenuation bias. And the second is that central bank information is relevant, but we don't know if it causes or merely predicts the trajectory of the economy. Thank you very much.
Thanks very much for organizing this wonderful conference and asking me to be part of it. Waiting for my slides. Okay. It's a really nice paper, and it's easy to read, and I've had to discuss much harder papers, and so this was a much more pleasant assignment. So what does the paper do? So it identifies high-frequency policy shocks. Now that is not new, right? We've done that before in the literature. How does it improve on the literature? It takes those high-frequency policy shocks and disentangles them into a pure monetary policy part and a central bank information shock. And so that's quite a clever idea. And the idea is incredibly simple. If it was a pure textbook monetary policy shock, say a tightening, but it would be the opposite for an expansionary shock, is that then, of course, the interest rate would go up, so there would be an unexpected change in that Fed funds futures. But if it's a standard monetary policy shock, then the stock market would go down. So you would have this negative co-movement. However, if it's an information shock, then if the interest rate goes up, and at the same time the stock market goes up, it must be that, at least that's one interpretation that's being pushed in the paper, is that the central bank releases positive information about the future, and so their signaling is that the economy is going to do better. That's part of probably why they're tightening, and so people were not quite aware that the situation was that rosy, and so expectations improve and the stock market goes up. And so then you have the positive co-movement. Let me just skip that slide because the labels are wrong. Okay, so these are the impulse response functions in response to those two different shocks, the pure monetary policy shock, which is the column on the left, and then the info shock, which is on the right. I've left out the two one-time shocks, and so the top row is the response for the one-year government yield, so that goes up in response to this tightening type monetary policy shock. And then below that you see the response for the S&P 500, real GDP, deflator, and then a measure for risk. Now the interesting thing is that they're different, but they're basically the flip side of the other. They're not quite the opposite, but almost. I'll get back to that. Right, so it definitely is a very plausible, interesting story. And so let me just skip this one too. Okay. I think it's a clever idea. It's really important that we get these pure monetary policy shocks right, because that's basically the only convincing way that we can figure out what is the impact of monetary policy on the economy without writing down a full structural model, and we all know how incredibly difficult that is, right? So it is an incredibly important research question, and we can learn a lot about that. It is a little bit sad that we only can look at those unexpected shocks, right? But if we look at responses of the central bank to what the economy does, then we cannot disentangle the impact of monetary policy and the underlying cause. So we're sort of stuck with looking at the impact of those unexpected changes. The analysis is incredibly careful. Is that the discussion is very clear? Is that they do robustness analysis? And the other thing I like is that they actually look at the realizations of the shocks. I mean, I'm getting older now, so I've read lots of papers, and I've read lots of papers about the identification of monetary policy shock. And very often people come up with a new way to identify policy shocks, and they never ever look at the time series of what they've identified. And it's really nice that these authors actually, they very carefully look at particular episodes and then ask themselves, this technique that we came up with, does it actually make sense? So I just have some minor comments and questions. So the first is whether the identification could be a little bit more precise. So again, consider one of those pure monetary policy shocks. Because of the effect on the discount rate, that will have downward pressure on the S&P 500, even if monetary policy had no impact on future dividends and real activity. Okay, so now suppose you take the exact same shock, but at the same time the Fed also releases a little bit of good news. Then because of the discount rate effect, which is very likely still going to be there, the S&P 500 would still go down. So you would still have that negative co-movement. But the authors would say, no, that's a pure monetary policy shock. So some of what they see as this negative correlation, negative co-movement shocks, could still be affected by central bank information shocks. So they may still be overestimating what they call monetary policy shocks. Okay, so now, suppose it's a completely different view of the world. Maybe one I shouldn't try to utter at a central bank conference. Suppose that these monetary policy shocks have no impact on the economy at all, nothing. Right, so has no effect on the S&P 500, no effect on real activity, right? For example, what you would get in a new Keynesian model with fully flexible prices, then these nominal shocks to the nominal interest rate would have no impact on real activity. However, but suppose that every time there is an announcement, there is some release of positive or negative news about the future that the market was not aware of. Okay, so that would mean is that in the graph, right, that Marek showed, so on the x-axis we have the unexpected changes in a nominal interest rate, which in this alternative view of the world have no impact. And on the vertical axis, we have the unexpected changes in the stock market. They would just be randomly distributed across this space. Now, suppose you then do their identification method, right? So in the top, I've got to get it right, the top left and the bottom right, those would be what they call pure monetary policy shocks. And then the other one would be the central bank information shocks. I think you would still get exactly their results. Is you would get that in the left column, go back. Right, so in the left column, you would get where the stock market goes down. If the stock market goes down, then GDP will go down, and then this risk measure would go up. And if you're on the other diagonal, is that you would the right column. And since these impulse response functions are almost a mirror image of each other, it could be that it's all information shocks and no monetary policy shocks at all. Okay, so Marek pushed two interpretations of the information shock. So one is it's a true new information, is that the central bank had better information than the market, and that's being released, and the market through the stock market responds to that. The other one was self-fulfilling expectations, which I find a little bit more interesting. And I tried to ask myself, can I come up with others? And that's a little bit difficult. One possibility is that this shock introduces uncertainty about R, since the stock price is the net present value of the discount rate, and that's a convex function, that possibly could do it, but that's kind of far-fetched. But the other possibility, and again, maybe not the right one to utter at a central bank conference, it's a change in the policy rule. As an example, suppose in a particular type of shock, the market thinks the Fed has gone crazy. And so the example actually follows on Marek's example. And so that's during the recession of the early noughties. I remember when that happened. So that was a very mild recession. And this was when we sort of learned the Taylor principle that the central bank is supposed to respond incredibly aggressively. And that's what they did. So even though this was an incredibly mild recession, the central bank lowered the federal funds rate like crazy. And I remember thinking, they're absolutely nuts. Now, maybe I'm a wimp and I didn't quite understand, the Taylor principle, but I thought, this is extreme what they're doing. And so interestingly, is that what they identify, that's an information shock, right? And so in this paper, that's being interpreted as the market thinking that the central bank had more negative information about the economy than they had while they were lowering the interest rate. And so it's interpreted as a negative information shock about the real economy. An alternative is the market thought you're way too aggressive. This is that you're doing something that you've never tried before, and maybe this is incredibly risky and I don't trust what you're doing, and that's why the stock market plummets. Okay, so I have to raise this point, even though it's an old one. So like I said, is that we have no choice, right, but to focus on these monetary policy shocks. And so I sometimes have conversations with people on monetary policy committees and even central bank governors. And then I ask them, do these monetary policy shocks exist? Are you ever surprised by what comes out of the meeting? And then most of them, they say no. These shocks don't exist. Monetary policy is always in response to something that I see in the economy. There are not these purely exogenous shocks. So academics, of course, they've come up with stories to justify what they're doing. And I think the best one is that these monetary policy decisions are made in committees, and sort of the bargaining power or who's most convincing, that is a bit random. That depends a bit on the best good night's sleep last night, or who had a fight with their spouse, and sort of a bit more convincing. And so that's sort of one story where you have sort of these tiny little errors. Now, interestingly, is that our estimates of what those shocks are getting smaller and smaller over time. Right? So over here, one standard deviation shock is only 3 to 6 basis points in this Fed funds future. So that's already small, but that raises the question: can we really take these tiny little things serious? And we build so much of our analysis on such tiny things, and so we should wonder whether that's really a sensible thing to do. I understand is that we don't have very good alternatives, but still. Okay, so my last point. Okay, so consider a pure monetary policy disturbance. It is tiny, but the impact is massive. It's massive because the impact on GDP seems to be almost persistent. The impulse response functions are shown for 3 years, and during that period it seems to be almost flat. Maybe it is even permanent. But also the impact on the S&P 500 is really big. If you try to do some simple calculations through the discount rate, is that you're not going to get close to the 100 basis points drop in the S&P 500 for these tiny increases in the discount rate. And so then the effect has to be that monetary policy has a massive impact on the economy. Now they do get that in their DSD model, so it's not completely impossible. Anyway, my concluding slide. I really do think it's the spirit of this paper is really nice. These monetary policy shocks, we don't really understand what they are. I think this paper comes up with a really sort of nice story, what's behind it, right? They say maybe it's information, which I actually think is an incredibly sensible story. I worry a lot more about these pure monetary policy disturbances. And of course, by disentangling, right, this monetary policy shock into 2 bits, this monetary policy shock has become smaller. But since we don't have a good story about that, I'm not sure we should worry a lot about that. And so maybe the next conference, that pure monetary policy shock is going to be split even further, and it's going to be even smaller, and at some point maybe it's going to be 0. And then all these governors who told me that these shocks don't exist turn out to be right anyway.
Okay, thank you very much. I think it makes sense to give Marek an opportunity to answer to these questions, and then we will collect a couple of questions from the audience as well.
So, thank you. Does it work? Yeah. Thank you very much, Wouter, for the discussion. Yeah, I agree with your comments that we could further refine the identification. I just thought that it's a good strategy to start with the simplest approach that works and then go on refining it in the next stage. And yeah, we'll think about your comments. So one thing on the magnitudes. So you said that we have permanent effects on GDP. So this is a common finding in if you estimate Bayesian VRs now and you impose the standard priors, then all the impulse responses become permanent, and then you wonder, then this means that shocks have massive effects. If you relax those Bayesian priors, if you estimate by the OLS, you tend to find less persistence, and all your impulse responses come back to 0. It's just that when we compare the forecasting performance of the VRs with the Bayesian priors forecast better. So that's why we use that as the benchmark. But I agree that sometimes the implications for the economic implications are more surprising.
Okay, thank you. If there are questions in the audience, yeah, and using my power of the chair, I'm going to ask the first question, if I may, please. I'm wondering about leakages of information, whether those happen at all, whether the market is bracing itself for the release of the news, and then it's difficult to say what is actually happening after the news are released, and do they have a positive effect on the economy, if the economy has already increased, expecting those news or not. So I guess the way to do that would be taking a longer window, not 10 minutes before the release, but longer than that. And I don't know whether there is a consensus in the literature about that or not. And maybe we can collect a couple of other questions, and then Marek will answer all of them together, please.
So my question is related to Wouter's point on the cloud that you use for the futures and for the S&P index, and the point about that giving you an identification strategy that it's inevitable you'll find something there, right? So my point is the following. So I thought that the high-frequency identification idea was to narrow down one event on the time domain so that there's only sort of space left for one event, one shock. Now, you guys, and correct me if I'm wrong, if I'm misunderstanding, you guys do that, but then you're saying, well, that one event ends up being identified with 2 events, and so you add in the sign restrictions, but sign restrictions are allowing you to do not sort of fully allow you to identify. They identify the sets sort of outcomes for the 2 components. You add in the orthogonality restrictions on top of that. So if I understand correctly, you're saying it's one event, but there's 2 events, and they are completely orthogonal to each other. So to me, how do you go about that? Even though the source is one event, the components are completely unrelated. So I would start with the other end. I would assume that they're related and try to find information that would pin down how they can be related. Are they sort of more orthogonal than not, or they are highly correlated?
Okay, maybe Marek can answer these 2 questions, and then we can collect a couple of others.
Yeah. So leakages of information. I mean, we don't capture anything that was leaked. So now there is a trade-off. Now, when you use a longer window, you will capture well, perhaps some leakages, or you will give economic agents more time to process these announcements and maybe reflect them better in the prices. But there is a trade-off because there are also inevitably other pieces of news unrelated to monetary policy that then contaminate your measures. And I don't, we don't have much own research on that, but I understand that the literature has conversion using this half-hour window, and that's what we're following too. But it would be interesting to study that. Now, so there's only one event. Now, the one event is this monetary policy announcement that, at least in the US, it's only one event, a monetary policy announcement, which also contains both news about the monetary policy and news about the economy. So it has those two shocks inside. Now, there is nothing that would, I don't know. There's nothing that suggests me that these two things will be correlated. No? So sometimes it can be just the monetary policy decision that's surprising. Sometimes it can be just the economic analysis that's surprising. I think, to me, the most natural assumption is to think of those two as orthogonal.
Okay, let's collect 2 to 3 questions from the audience. Yes.
Hi. So since we're at a conference about communication, I was actually wondering if there's anything in the work that you've done that can yield some insights more specifically about communication. So in particular, I was interested in your result that it seems that the ECB shocks have more of an information component when you decompose these things, and I'm wondering if that might have something to do with the fact that the ECB has always issued a statement after their announcements or decisions, I should say, whereas with the US Fed, they started issuing statements later in your sample, and I'm just wondering if you had done any exercises where you excluded Fed decisions that were not accompanied by statements or were accompanied by very short statements that didn't really convey any information about the economy, but just announced literally what the decision is.
Okay, and one more question. Okay, yeah, please.
I was just wondering if you had done any, or if you had a look at expectations data. If Fed information shock reveals information to private market participants that they didn't have before, then you should see a revision of their expectations about macroeconomic outcomes. We have a plethora now of expectations data, surveys of professional forecasters, etc. I was wondering if you see any reaction in those for the Fed information shock. Thank you.
So going backwards, yes, we also looked at what expectations do. So for expectations, we find that they react in the same way. So they react positively to positive news and negatively to negative news. But what's interesting is that this response is very much delayed. So on impact, there is very little, and then they move farther. So yeah. So. Yeah, so to me, that's an argument for using a VER and tracking the dynamics of all the variables, also of expectations, as opposed to just doing event studies and looking what expectations do on impact, because the expectations have the dynamics of their own, and they get revised later. And now, so this pre-94 period, this is indeed, until 1994, the Fed did not issue a statement accompanying its decision, and the markets were figuring it out from the movements of the Fed funds rate in the first, after the first open market operations. So, sure, we've tried to exclude this, the beginning of the sample, and that does not change the results. But then I didn't have time to talk about this, but it's interesting if you actually include that period and we look at the information shocks and monetary policy shocks in this first few years where there were no announcement, where there were just movements in the Fed funds rate. Because those theoretical models predict that agents will then parse the interest rate change, and they will allocate part of it into a monetary policy shock and part of it into the update of their beliefs about the economy. And this is pretty much what we see. So we see that in this beginning of the sample, we have a very strong positive correlation between the two shocks, and this correlation disappears after 1994.
Okay, I think we have time for 2 more questions. Yes, please.
Thank you. Probably my question goes to central bank credibility side. When you say that the central bank increases the rates and then we all expect that the stock price should come down, is there any kind of thinking in your structural model, being it New Keynesian or other way, that when prices don't go down but they kind of stable or go up, it may be related to market participants think that the central bank would do whatever it takes to bring back the inflation to the level that they expect, and that will create something which is more favorable and more forecastable for the long term. And that's kind of driving their behavior today. Is it somehow included in your structural thinking, or?
Yeah, and one more question.
Etibar Jafar from the IMF. My question is that if we assume that markets functioning really perfectly and they, there's correlation between this interest rates and stock prices in real time. Actually, I don't know which stock prices you used in real time, or matching this interest rate timing or not. Because if you use the same timing, then if markets are like functioning perfectly and they're why interest rates actually, derivative prices, also do not respond to the same information shock. Both stock prices and interest rate derivative prices should respond the same way, no?
So we're looking at both interest rate changes and stock prices in a half-hour window. No? And obviously in a half-hour window there is no way for policymakers to respond. And as for the previous question, so I think your I don't know, but perhaps your concern is the same as the concern of Wouter's. Now, are there really monetary policy? Are there really any relevant deviations of policy from the Taylor rule? And I mean, I don't know what to answer to that. No, these are the empirical results that we have.
Okay, I guess we have to stop here. I would like to ask audience to thank Marek and his discussant Wouter for very interesting presentations. Okay, thank you very much. And now we are ready to turn to the second paper by Zeno Anders from the University of Heidelberg. Yeah, please.
Okay, so thanks to the organizers for putting our paper on the program. This is joint work with Franziska Hündekes, who's also here, and Gernot Müller. So the question of the paper is, how do monetary policy announcements impact firm expectations? And why do we focus on firm expectations? Well, in theory, it's the expectations of price setters which are crucial for the transmission of monetary policy announcements to the economy. However, so far the empirical evidence has been limited to analyzing the effects of monetary policy announcements on the expectations of professional forecasters. And in this paper, we're trying to fill this gap by employing a unique data set which covers more than 2,300 firms, which gives us more than 200,000 observations in total, and includes a direct measure of expectations. And the day of the response is also recorded. I'm going to come back to why this is important, but first, why do we care about announcements at all? So in central bank practice, managing expectations of the private sector has become an increasingly important policy dimension. Think about, for example, forward guidance at the zero lower bound. Yet in theoretical models like the New Keynesian model, the predicted effects seem to be quite too large to be credible. And also the empirical studies have given some counterintuitive results so far. For example, they've shown that announcements of expansionary non-conventional policy actions indeed reduce monetary interest rates, market-based interest rates, but they fail to raise inflation expectations, and they tend to reduce production expectations, which is somewhat counterintuitive. And one theory that has been put forward to explain these findings, which has also been introduced in the previous paper, is the so-called information effect or signaling channel, which works the following way. So if agents in an economy think that the central bank is better informed than themselves, then expansionary measures can actually reveal bad news about the economy. We have just talked about this. So agents think that the central bank must have had a reason to stimulate the economy, so probably the economy is actually in worse shape than previously thought. And then price and production expectations can actually fall. And relatedly, in this paper, we find evidence for a nonlinear effect of policy announcements on expectations, which means that announcements of large policy actions have smaller effects than announcements of small policy actions. And this nonlinearity cannot be explained by a combination of monetary policy shocks and central bank information shocks from the previous paper, and not by isolating effects of central bank communication. So our results are consistent with the notion of an information effect where only large shocks generate such an effect, and the information content is embedded in the policy decision as such. Well, there's some more literature on this topic, of course. Gabor and Verchenko have contributed to this extensively, and also our discussant, but let me skip that in the interest of time and go straight to the data. So we're going to use the E4Business survey industry, which covers German firms in manufacturing from 2004 until 2018. And one unit observation here is one plant or business area of a firm. But I'm going to refer to firms nevertheless in the rest of the talk for simplicity. So in total, that survey has 400,000 observations, but we can use more than 200,000 observations because here firms have responded online and we know the day of the response. The questions regarding the expectations are the following. Expectations for the next 3 months, taking changes of terms and conditions into account, our domestic sales price for a specific product will increase, stay the same, or fall. And correspondingly, the expectation, it's asked whether expectations or whether the domestic production of a specific product will probably increase, stay the same, or fall. So we only have qualitative data, which is a disadvantage, but I think this is also a reason why we have such a high response rate and we get so many answers. In terms of monetary policy announcements, we're going to rely on the database compiled by Alta Villa et al. So thanks a lot for sharing the data with us, even before it was made official, which was, I think, a couple of days ago only. You're going to hear more about this database tomorrow, but in short, it includes high-frequency interest rate changes around monetary policy events, where a window around such an event consists out of 2 sub-windows. One is a window around the press release, and one around the press conference. We're going to use the full monetary event window for the baseline and then the narrow windows later on. But before using that data, we first conduct an event study to identify the effects of announcements of non-conventional monetary policy measures by the ECB on price and production expectations. So here we follow largely Del Negro and co-authors, but we're going to analyze firm expectations instead of those of professional forecasters, and we know the day of the response. So that means we can focus on a narrow window around the announcement, and we don't have to take care about other macroeconomic developments that might have happened in the same time. We're going to pool our observations between January 2009 and June 2018 and run the following regression. So on the left-hand side, here we have the change of expectations of a specific firm regarding prices or production relative to the expectations in the previous month. On the right-hand side, we have a constant, we have the lagged level of expectations, and we have some firm-specific control variables like prices, production, demand, orders, foreign orders, capacity utilization, and the average state of business. Then we allow for each event to have a different impact on expectations. That's this beta M here, so M stands for events, and we multiply that with a dummy which takes the value 1 if a firm has responded 2 working days after a specific event, and it takes a value of 0 if it has responded 2 days before the event. No, and we disregard all other observations, except if there was no announcement at all in the month, then we set the dummy to 0 and include the observations. So what do we find? Actually, not that much. So depending on if we include control variables or time-fixed effects, some of these announcements had a significant effect on expectations, that prices on the left and production on the right, but many of these announcements did not have a significant effect. If it was significant, it was most often actually negative, although these were expansionary measures. And if you look at Marek's decomposition of the shocks, you might guess why this is the case. So here we plot with a red diamond the interest rate change during the announcement, with the dark blue or gray bars, the monetary policy shock as identified by them, and with a light blue one, the central bank shock. And what you see is that for some large shocks, the monetary policy shock and the central bank information shock went into the same direction. That means that some large expansionary shocks were actually accompanied by bad news, which might explain why we don't find a significant reaction from many of these expansionary measures, or even some with the wrong sign. So to get a better understanding of this, we broaden our scope and look at monetary policy surprises in general, not only non-conventional ones. So for this, we use a full sample, 2004 until 2018, and we use the database of Altavilla et al. That features 173 monetary surprises, and we can use 147 out of these because they can be matched with firm-level data. Then we again use a window of plus or minus 2 working days around the event. That means that this dummy here is 1 if the firm has responded 2 working days after the announcement, and a 0 if it has answered 2 working days before. We stick the coefficient to be the same for all announcements, but we include the size of the shock. So this monetary surprise, that is a change in the 1-month overnight interest rate spread in the event window. That means during the announcement. And the other variables are actually as before. What do we find here? Well, again, not that much actually. So the change in the interest rate here in the top row has a barely significant positive impact on price expectations, that's on the left-hand side, and no significant effect on production expectations once we take control variables into the regression, which are second and the fourth column. Taken at face value, that means that actually expansionary monetary policy announcements, that means interest rate cuts, decrease price expectations, which is somewhat counterintuitive, but it also fits to what we have found for the non-conventional measures. But if we think about it for a minute, these non-conventional announcements, they triggered quite large interest rate responses. The typical or the average change in the 1-month overnight interest rate spread during the non-conventional announcements was double that than for normal shocks. So our conjecture is that large shocks might bias our results. And that is the case if large surprises have a different effect than small surprises. And in order to explore this nonlinear hypothesis, we proceed in 3 ways. In the first one, we use a semi-parametric approach and sort the surprises by size, put them into 8 different bins, and allow in each bin for a different impact of the shocks on expectations. In a second step, we plot non-parametric kernels, and a third one, we include a cube term in the regression. Okay, so let's start with the bins. For small changes in the interest rate, which are here in the middle of the x-axis, we get a significant negative impact on price expectations on the left and production expectations on the right. The bars here are 95% confidence intervals. That means for small interest rate reductions, we do get the predicted, or by standard theory, predicted effect of increase in price expectations. But if we move further to large shocks, so the negative ones are further to the left and positive ones are further to the right, this effect turns insignificant or even turns around in a sign. When we plot the non-parametric kernels, we directly show the impact of expectations, so not the coefficient, but directly how expectations change with interest rate changes. So again, for small changes of the interest rate, we get a positive impact on expectations, but for larger changes, this turns insignificant or even switches sign. And the same for production expectations on the right-hand side, and of course mirrored for interest rate increases. So in order to save on the degrees of freedom and also to include a single statistic that we can also test for significance, and one that can actually capture this S-shaped form of these pictures, we next include a cubic term in our baseline regression, additional to the linear term. And what we find is that this cubic term, that means the change in the interest rate to the power of 3, turns out to be highly significant once we include the control variables. In order to visualize what that actually means, we proceed in the following way. We plot the linear effect with a straight line, which is based on the coefficients here for the linear interest rate change in our regression, and then plot the combined effect of the linear term and the cubic term as this curve here. And we include the confidence intervals of the cubic term to see if the combined effect is different from being linear. And what we find is the same as before, basically. Small interest rate decreases increase price expectations, but if you move further to the left, this tends to go towards zero or even reverse its sign. And the same for production expectations and mirrored for interest rate increases. So we find a significant effect for smaller effects of large announcements. And this is in line with the information effect that I just mentioned before, where surprises, so large expansionary policy surprises may carry bad news or trigger a reassessment of expectations. So this would be equivalent here. And our results are robust to changing the window around the surprise for using different interest rate, for a sample split, for including firm fix effects, for interaction with a recession dummy or with uncertainty dummies. So Rüdiger, this was not in the version we sent you. We just added this in the last days. So to a host of robustness checks. So in order to get a more structured view on this, we next want to ask if a direct measure of central bank information can actually account for our results. That is, can Marek's decomposition into a central bank information shock, so a linear combination of a central bank information shock and the monetary policy shock, account for our non-linearities? And indeed, if we include the central bank information shock, it has an expected sign on, at least on prices. So positive information shock increases price expectations if we use that instead of the cubic term. And this is also reassures a bit the identification scheme. However, in order to see if they can explain our nonlinear findings, we include the central bank information shock together with our cubic term in our baseline regression. And what we find is the following: while the central bank information shock is still positive, at least for price expectations, the cubic term is still significant and positive, and the pictures hardly change. So that means that a central bank information shock cannot account for our nonlinearities. And that might have to do with its identification and actually the question which came up before in the discussion, because the central bank information shock in Marek's work is by construction uncorrelated to the monetary policy shock. But we find the information effect to be correlated with the size of the shock, of the monetary policy shock. So this is some sort of a different concept, this correlation. As an alternative, we also explore whether central bank communication can explain our results. And the idea is the following: if the ECB, each time it cuts the rates by a large amount, it justified this with a gloomy outlook on the economy, that could also explain why we find this evidence for this information effect. So in order to isolate the effects of central bank communication, we disentangle the effects of the interest rate changes that occur during the press release window and the press conference window. Where in the press release, there's not much more than a monetary policy decision as such. We have seen one of these examples. And in the press conference, you have the accompanying central bank communication. And what we find is that even for the press release window, the nonlinearity remains highly significant. That means even in the monetary policy decision as such, without the accompanying central bank communication, we have this nonlinear effect. Now, these pictures are also for the press release window. The pictures for the press conference window look a bit different, so there are different dynamics going on. I've got in the appendix if you want to see them. Okay, so that's already it. So to conclude, we were asking how do monetary policy announcements impact firm expectations, and we find evidence for a nonlinear effect of announcements, where large announcements have smaller effects than small announcements. And this nonlinearity seems to be embedded in the monetary policy decision as such. Implications for central banking, maybe there's some call for gradualism. That means if the central bank wants to reach something, it should take small steps instead of large steps. But of course, if you want to draw these policy implications, you need some more model-based analysis of optimal monetary policy. Okay, thank you.
All right, I'm going to thank the organizers for having me discuss this nice paper until the slides are up. All right, very good. All right, so let me just delve right into it. What's the research question? I think Zeno summarized it nicely. Do monetary policy announcements influence expectations? It's basically addressing Emmanuel's question from before. Specifically, announcements of unconventional policy measures, press conference, press releases by the central bank more generally, and what's the mechanism behind it? Is it sort of standard textbook economics, or whether it's this oracle effect in some sense, this Delphian, no one used this word, but it's in the paper, sort of this Delphian effect in some sense. And they do this in the context of ECB announcements, German firms, production and price expectation survey data from the Munich-based IFO Institute, okay? And the big message here is nonlinearity. So regular sized changes in monetary policy have expected sign, an increase in interest rates lead to lower prices, lower production expectations, larger changes in monetary policy appear to have a zero effect, and unconventional monetary policy announcements have either zero effect or even a flipped sign, okay? And the authors interpret their results as a Delphic effect of the monetary policy measure itself, as we just saw, not the communication thereof, which sort of offsets the conventional monetary effect, pretty much exactly, okay? That's where the zero results in the linear regressions essentially are supposed to come from, okay? All right, so now I'll have to poke, I guess it's my job to poke some holes into the paper or raise some questions. I'll do that. I'm going from very specific to sort of more general. That's the plan. So I'll start with some smaller questions. These two graphs is basically plotting on the left-hand side is a plot of the share of firms that actually respond online to the IFO survey. And then the right-hand side is a plot of the distribution of responses within a month. And you can see these are not flat. None of these are flat graphs. So firms, you know, they respond apparently more heavily towards the beginning of a month. And of course, online responses have trended up over time. So, you know, there might be selection issues going on. Some simple questions. Are firms that adopt online responses earlier different? Okay, and if so, how? As for the right-hand panel, are firms that respond earlier in a month compared to those that respond later? And how does that sort of compare to the monetary event dates distribute over a month? Are they randomly always on the third Thursday in a month? I just don't know. I was too lazy to look up, quite frankly. But the question is it random, or are we always getting a particular slice of the firms in some sense from that right-hand panel, okay? In which case that might be worrisome for this generalizability of the results, okay? And last point is a small question. It wasn't clear to me. There are some months where you just simply don't have response dates for some data blip, I assume. But what wasn't clear to me is that conditional on having some information on response dates in the months, you have them for all firms, or is there also sort of a within month selection in terms of response date or not? And if there is such a selection, then we would again like to know, I haven't found anything in the paper about that, whether these firms that have a response date or not, whether they are somehow different. So those are sort of selection issues we might worry about, okay? These monetary policy events, here I list them, they are very sort of heterogeneous, but they'll belong into groups. So one question is, and sort of you can see, I mean, Zeno said there's not much going on, you know, sort of these results are all over the place. Not many of them are statistically significant. So one way of potentially gain statistical power would be to actually classify them into groups, okay, and impose equality of the treatment coefficient within group, and maybe you can learn a bit more from that. I don't know whether you tried that, but that's something I would try. If you're not willing to do that, or if you don't learn anything from that, it would still be important to understand where the heterogeneity across these events comes from. In particular through the lens of your preferred explanation or some other explanation. So why is it that in some events the Delphic effect dominates and some others not? Okay, there's a little in the paper about that. Obviously, I think that one would like to know. I would be curious about that, okay? Yeah, I'll skip that small issue. Last smaller point, if I at least look at the production, so Zeno said it's a non-linear reaction. This is the semi-parametric exercise that he showed you. If I at least look at the production side, which is the production expectation side, which is the right-hand panel, is it non-linear or just erratic? I don't know, okay? And some of the, so it's not clear to me that I see anything in the production side. So I guess this is a bit in the eye of the beholder, but I think it's worth thinking about that question, okay? again, nonlinearity can often just be erraticness. All right, sort of moving on from smaller questions, a bunch of proposals, a bunch of ideas that I had when I read the paper. I think the paper would benefit from would benefit from giving the reader an idea about the magnitudes of these effects of the announcement on firm expectations. So, sort of in general, we know that I've worked a lot with this data myself, that most of the variation of these expectation variables, of the survey variables in general, is highly idiosyncratic. So how much is the ECB even moving? Okay, sort of, and even if it's just small, but I think we would like to know to sort of not lose perspective of how much we are dealing with here. And similarly, sort of a related, just inform the reader about the additional R squared these ECB announcements have for firm expectations. My guess is not much, but I think we would like to know. Yeah, you could run a few placebo tests as well, just sort of do due diligence for, you know, these kind of event studies. About the events window, I mean, there's always the trade-off between, you know, getting the identification tight, but then we also know from Juris and co-authors' work that, you know, that especially firms, there is a huge wall of inattention, especially to all things monetary policy. And it's not clear that a plus minus 2 days event window is good as a baseline. To be clear, they do the robustness check with wider windows, even a month window. I'd almost suggest to you that might be your baseline, but anyway. All right. Other ideas what you can do with a survey. I think the survey is a bit underused. For example, to test the regular monetary policy channel, which is really a standard demand channel, right? So you lower interest rates, and then demand should benefit. Both prices go up and quantities go up. Why not use the additional survey questions from the IFO to sort of get at that a bit more directly? Unfortunately, there isn't. There used to be sporadically a question about expected demand. What do you expect about your demand? That's unfortunately no longer in the survey, so you don't have a good time series for that. But there are indirect questions that you could use. For example, there's an inventory question in the survey where firms ask, are they sufficient? If that demand channel is really going on, what should happen is, for an expansionary pure monetary policy announcement, fewer firms should respond with yes, right? Because they expect higher demand, and so their inventory, by the way, inventories of final goods shouldn't be as sufficient on average, okay? So you could use the survey a bit more. Similarly, if you wanted to test this Delphic channel, again, there are questions in the survey, additional questions in the survey that, by the way, they are aware of because they use them on the right-hand side. You could actually use them on the left-hand side of the regression. For example, the question about business situation, which should jump upon a monetary policy announcement, a question about business expectations, and is sort of, if the Delphic channel is going on, you know, that the business situation potentially and the business expectation should immediately change. Okay, and you could kind of try to tease that out. I mean, so it would be just interesting to see how both these variables, these inventory variables and these business situation variables react to these surprise monetary policy announcements. If they react non-linearly, the way prices and production react, then they better react sort of in a similar way as the proposed mechanism suggests. Potentially they react without a sign change. And if that's the case, then you might actually be able to use them to actually quantitatively disentangle the direct demand effect from the Delphic effect. So in other words, use them as a first stage in some sense to actually disentangle the two effects. I don't know which way that goes. That depends a bit on what the result will be of that first stage regression. But it's, at the very least, it's a good insanity check. In the good case, it might actually help you to disentangle the two channels, or the quantitative strength of the two channels. There's a bit of a problem also with the, and there's nothing you can really do about it, but I would be remiss if I didn't point that out, is the discrete nature of these of the left-hand side variables of these expectations. It's basically trichotomous, up, down, stay the same. But of course that means that your changes, the change variable is rather limited, okay? So the problem, if firms, for example, were already going to increase prices without the expansionary monetary policy shock, they just have nowhere to go with their answer. And I don't know how that biases the results. I haven't thought through the econometrics, but it's not clear. I mean, there's certainly some non-linearity built into the almost empirical design. There is some continuous measures, the visual analog scale for business situation, business expectations. You could check whether your non-linearity also shows up there. Then at least you would be sure. You could be somewhat assured that the non-linearity is not coming from survey design and is rather there. The caveat, of course, that the business situation and business expectations are not quite what you want. At best would be a first stage, as I mentioned in the previous slide. But at least you could check whether this non-linearity that you find is due to bunching somehow, in some sense, bunching of these change variables from trichotomous level data. Okay. And lastly, this goes a bit to the remark of Marek that maybe these expectations take a while to change. Why not test whether firms actually follow through with their change expectations, because you have the realization variables too next month. So that they should have answered whether they changed their production, and the direction, and similar with prices, so you could figure out whether they not only expected to do something, but actually the outcomes, at least again in a qualitative way, through expectations. So in other words, do expectations matter, and do they matter through actual outcome variables? So you could easily test that, how relevant this channel is for outcomes. All right. Now sort of a few bigger picture comments, and then I'll conclude. So I'm certainly having a lot of sympathy for the Delphic interpretation of monetary policy announcements. I've found some support for it in my work, but questions remain, I would say. Okay. For one thing, is it plausible that by and large the Delphic effects appears to exactly offset the standard policy effect, so that the net effect for large announcements is zero? It's not quite right, but overall that's what seems to come out of the paper. That seems like almost miraculous. I mean, it could happen, I guess, but I mean, is that what we expect to find? And again, citing Yuri's work, there's so much inattention by firms to all things monetary policy for the Delphic effect to work, that can't be quite right. They have to be attentive, actually. They have to follow this stuff. And we know, at least in New Zealand, that they don't seem to do that. And the other thing that might speak against the Delphic effect is that we find them also with professional forecasters. I mean, of course, it would work if you think that professional forecasters also have less information about the economy than central bank staff economists, and also getting new information after the central bank announcements. Is that plausible? I don't know. I mean, are these guys worse? Are these guys better? Most people in the room would probably say central bank staff economists are better than the professional forecasts. I don't know. You could actually test this. There might even be a paper out there comparing, say, the forecast quality, the average forecast quality of the professional forecasters vis-a-vis central bank staff economists. But again, prima facie, it's not clear to me that the Delphic effect should also apply to professional forecasters. But it is in the data. It seems to be in the data. Okay, on the Jarocinski-Karada decomposition of the paper, I get the intention behind it, I understand it. But I also think it's begging the question a bit, right? The Jarocinski-Karada communication shocks are identified through positive stock market reactions concomitant with interest rate increases, which is exactly the Delphic effect. So how surprising is it then that in the microdata, the Delphic effect also shows up in exactly in a similar way to these shocks? I guess it's a reasonable sanity check, but I don't know that it's more than that. And so for this exercise to really stick, I think what we would like to know more. We would like to have direct access to the information set of the ECB. And this is, here I'm confessing my complete ignorance about monetary policy arrangements in Europe. But I don't know, do we have green book analogs, meeting minutes that we could use for this? I don't know. That's just something to think about. In the end, I mean, the Jarocinski-Karada does not deliver the desired explanation anyway. So, because they still, they don't really help to explain the Delphic sign flip. Okay. Lastly, policy implications. So I don't know if I was one of the practitioners in the room as a central banker, what am I supposed to do with these results? Okay, it's not clear to me. Should we try to be clearer and louder with our announcements? But then what do we do, if the Delphic effect dominates, or is Wouter might say actually the Delphic effect is the only thing that's there. Does that mean actually we should be louder and clearer, as some people said in the morning? Not obvious to me at all, especially, you know, with this huge wall of inattention that we know from, as again, Joris and Korda's work. Can the central banker even get through, Delphic or otherwise? It's not clear to me what that means for policy. So I don't know that our knowledge here is ready for prime time at all. All right. Summary, I think it's a very interesting paper using great German data that I encourage other people to look at. It is really great data. I've used them extensively. And sort of the three key points is nonlinearity versus erraticness in the effects. Okay. Is the Delphic explanation a good one for the results? Not clear to me. And what, if any, are the policy implications from these somewhat nonlinear or erratic results?
Yes, please, if you would like to address these comments now, yeah.
Yeah, I just wondered if I can have back my slides. That would be nice. Is it possible? Because I've got some tables which might answer some of the questions. The slides? Okay, so I can answer before the slides are there. So thanks a lot for great comments, Rüdiger. To answer the first one, I just go through in all of the discussion. So is the sample online different where the sample which is not online? Well, it's not. So we have, but it's a good point, of course, we have the variables here that we observe for the full sample and the sample with the participation date, and the means and so on, they are very similar. So the firms which respond online seem to be a good subsample of the overall population. And also the monetary policy announcements change across the month, so there shouldn't be systematic correlation with early and late answers. You ask if we don't have the response date, then if we don't have it for nobody or just for some. No, then we have it for nobody, then the IFO just lost some data, not really explainable to us, but then it's just gone for some months, but it's just, I think, 5 or 6 months. Classifying the events, the non-conventional events, into groups. I mean, we have a large number of firms, but still maybe a good idea to see if we can find out more. Then the point about if this is erratic or not. Well, I admit that for the production expectation is not really clear, but this is also driven a little bit in the picture by this last point here, but there are 3 monetary events in there, so this is not really something big in this very last point here. Otherwise, you get the U-shape, and that's also why we did this 3 ways. We also did the non-parametric kernels, and we included the cube term, which is highly significant here at the 1% level. So there is something there systematically, which is not erratic. In terms of magnitudes, too bad I don't have a mouse. I didn't show you that, but it might interest you. So since we have 3 possible answers, we can't really interpret that as a probability. But what we can do is we can quantify the effects in the sense that we calculate the probability of a price upward revision and a price downward revision, the same for production. And there we also, and then we have a linear probability model, and we can give you the corresponding probabilities. And maybe these are the numbers, and we calculated some examples to show you the nonlinearity for 1 basis point increase in these our interest rate that we observe. We get that the probability of a price expectations reduction goes up by 0.0 percentage points. For 5, it increases by more, and for 10, it actually already falls. So here we have the nonlinearity. For production expectations, these are actually higher numbers. Also, but you still have the hump shape. For 1 basis point, you get some number, 0.22 percentage points. For 5, it's more, and then it goes down for 10 basis points. Okay, so that's about magnitudes. Then you have, about the windows, you're right, if we use different windows, sometimes it even looks better. Here we have the maximum 1 month, so then the effects are even much more clearer and more significant so maybe we should use this as a baseline, as you have suggested. We had many other suggestions, so thank you for that. We're going to look through them, if we can incorporate them. The visual analog scale that the IFO had, I think it's a good idea of the IFO, but it's not really, it's a bit badly implemented. You don't even see the numbers there. You have to click somewhere in the blue between 0 and 100, and you don't really know where you are. So, but we can still try to use this. And we thought about the econometrics, so this, because we have these 3 categories, that should actually, if it does anything, go against us. We also control for lagged expectations because of that, but that should not artificially create these nonlinearities. And including the realized variables, yeah, we had that before, we should maybe do that again. We have a different paper where we show that expectations with the same survey matter for economic outcomes. So that would be then the next link. So if firms have specific expectations, they actually change their prices and their production in the following month. No? So we have a paper analyzing this in depth. I mean, it's a, we do many experience there, so that would be a bit too much for this paper, but we could maybe include a stripped down version. And then the point about the Delphic interpretation, so I was always a bit careful to say it's just in line with this interpretation. That we don't, it's some evidence, but it's not that this is the only interpretation. You're right, there could be different ones. I mean, it's not the case that the Delphic shock exactly offsets always the monetary policy shock. That depends on the size. You know? For here, around here, it's not, and then for further shocks at a specific value, it offsets. But it's not that all over the, as soon as you go here, a bit further to the left, then it always offsets it exactly. So, but of course, yeah, for the, it would be interesting to see a bit, or if other interpretations are in line with this. We also included Euroshocks to see if this helps up there. It gives us some indication, but still the nonlinearity survives. And in terms of policy implications, good questions. I don't want to go too far with the policy implications. We make some tentative conclusions, but we don't want to over-interpret our results neither. So there's more analysis needed for further policy implications.
Okay, we are now ready for questions, please.
Regarding your nonlinearities, it makes perfect sense to me as a human being that when I do things that are radically unexpected, I feel a need to justify them with respect to observable things and not merely my judgment. So it makes a lot of sense to me that when a policymaker moves greatly, they're going to talk a lot about how justified their moves are by the incoming data. I feel like at this point in the paper, that gives you an opportunity to go into textual analysis and use the textual analysis to try to knock out your nonlinearity. That would be the ultimate proof, in my view, of the truth of what you're saying.
Okay, do we have other questions? Please? Okay, I actually have a question. Oh, yeah, go ahead.
So regarding the point that the nonlinearities may have been introduced from the qualitative data with the 3 bins, I was wondering if you looked at, just consider the respondents whose initial expectation was in the middle category so that they did have room to change it. That might be one way to get rid of that kind of censoring problem. Or the other thing would be to look at the change in price and the change in production responses together. So if, you could say, does this firm change either of their price or production expectations? Because maybe their price expectations were already in the top category, but they do learn something from monetary policy, and then they revise up their production expectations, and they kind of would have revised up their price expectations had there been another category.
Yeah, maybe you can start with answering these questions. Yeah.
Okay, so first about the textual analysis, yeah, that's an interesting point. I mean, we did this check for the press release where there's a press conference, and we find it already in the press release. But it might be, of course, that maybe it's anticipated what the central bank will say in the future because it knows it from the past. About the other thing about the middle category, we could do that and checking the price and production together. But as I said, it should not really go against us because if everybody expects a high inflation in the future, that's a time when you should actually have contractionary shocks going on. And then that means everybody is high up, so that everybody has a chance of going down. So it's not, the limit is not that they cannot go higher up, but they can still revise the expectations downward as in standard as standard theory would tell you, and that is not constrained, no, because you have this. It will be only a problem if they want to go up more, but this is not what happens in these times. So this should not. But we can still conduct the checks that you have said.
Okay. Other questions? I just have a short question about these extreme policy events. How many how much data do you have? What is the proportion of the data that fall into this category, extreme events? Because you mentioned that in the very extreme case, extreme positive, now you only had three observations or something, right?
Well, that was for the very so slides are gone. I would have had also the distribution. So for the very extreme ones, there are small ones, but there's more than 5 basis points, and then it's kind of like Gaussian in the middle. So you have in the middle, you have a lot, but we extended all the bins, the size of the bins, to make sure that there are actually several hundred at least in each bin, except for the very large one, which is just above a certain threshold. So in the middle, where it's relevant, we have enough observations in each bin.
Okay. A couple of last questions. We still have time to do that. Well, if not, then I would like to thank the speakers, all speakers and discussants and presenters as well, for very interesting panel. And well, thank you very much for coming to Kyiv and presenting your research and discussing it with us. Thank you. According to the schedule, you would like to add something? No? According to the schedule, we have a dinner starting from 6 o'clock, right? Is that right? So now I guess we have some time to talk to each other, to network a little bit, right? And yeah, please do that. Do use this opportunity. Thank you very much.